Going to talk about the cash flow statement. Now, keep in mind that unlike the balance sheet and income statement, the cash flow statement is an analytical tool just as ratios are. The balance sheet and income statement reflect what they are intended to reflect and incorporate all categories of account. So in effect, they show everything from a financial standpoint that happened throughout a year, okay, or whatever time period. The cash flow statement then incorporates all 5 categories of account, in case anyone's forgotten. Five categories of account: assets, liabilities, equity, revenue, and expenses. That's it. There are no account categories that exist outside these 5. Now, in order for the cash flow statement to balance, it must incorporate all aspects within these 5 categories of account. Keep in mind, when I say analytical tool, just as I said with the ratio analysis, an analytical tool, number one, you have to understand how it's constructed, what the math is associated with it. But there's a more important question. If you can know the math all day long, but if you can't figure out what you're trying to find out, what you're trying to figure out, and how this specific analytical tool assists you, then who cares about the math? If it doesn't make the thing talk to you, then it doesn't accomplish anything. So, what is it that the cash flow statement should say to you? It should say where money comes from, and where money was spent. To put it bluntly, it should tell you how you got it and what you did with it, right? Okay. So that is the purpose of the cash flow statement. Now, the specific process, the math, if you will, involves 3 steps. Step number 1, you take net income and you add back non-cash expenses. Now, what does this step do? This step takes, for all those who've forgotten, revenue minus expenses equals net income. This is an incredibly short and sweet formula for the income statement, okay? So when you take net income, in effect, you're summarizing the income statement. You're saying this is all cash in and this is all cash out. Net income. Now, there are some expenses. Remember the assumption here, all expenses are cash out. There are some expenses that by their very definition do not, in this time period, involve cash out. What am I referring to? Well, specifically depreciation and amortization. For those who don't know the difference, depreciation relates to tangible assets, amortization relates to intangible assets, patents, goodwill, and I'll let someone explain that in a later video. So you have to add back those expenses that by their very definition are not cash out in this time period, okay? So you have net income. Net income plus non-cash expenses, that summarizes the income statement and therefore takes these two and the entire income statement off the table, okay? Short and sweet. You got rid of two. Now the second step is to compare and identify changes in asset and liability accounts. Now, the thing you need to know, when there are changes, which is source and which is use?
An asset increases
So,
use.
when an asset increases, is that a source or a use? Well, think about it. Let's say you have a vehicle account, okay? The corporation has a bunch of vehicles. If that vehicle account increased, there's only one thing that could tell you, and that is that they bought another vehicle. If they bought another vehicle, they're going to have less cash in their pocket because they bought, right? So, when assets increase, it's a use. Now, be careful. Some of this can be counterintuitive. When accounts receivable increases, that's a use. Well, yes, because you have to finance that increase. So it can be a little tricky if you're trying to, if you will, figure it out. So what I would say is, remember the guideline, this, and use it, and even if it seems counterintuitive, just use it. And it'll come to you later. You'll start to see the picture later, okay? Now, liabilities. I've got here that an increase in liability is a source. If you have a $50,000 bank loan and that goes to $100,000, you've got $50,000 in your pocket. Sweet. That's a source because you got $50,000 in your pocket. If, on the other hand, that $50,000 went to $25,000, that means you paid off a portion of that bank loan. Paying it off, decreasing the liability from 50 to 25, means it's a use, okay? So you have to do this, compare this year and last year for every asset and every liability account, right down the line, and it'll either fall in the source or the use category. Okay, number 3 then is to identify changes in equity not associated with the income statement. Hopefully everyone's aware that an income statement reflects the changes in equity over a period of time. Well, let me add to that. The income statement reflects operational changes in equity. There are other changes that can be found in equity that are not associated. Remember, we wiped out the income statement, right? So it's no longer an issue. But we then have to identify whatever other changes there might be. What would be examples of what I'm referring to? Dividends, for instance. That's not an income statement item. In fact, you'll hear that corporations are subject to double taxation, and this is the reason why. Because dividends are paid by a corporation with after-tax dollars. They have to pay tax on those dollars. And then the recipients of the dividends, stockholders, have to pay tax on their receiving the dividends. Double taxation. That's what's meant by double taxation in corporate America. Okay. What would be another example? If they sold stock. That's not an income statement item. It's not operational. If they bought stock and brought it back into the company under the name treasury stock, that would not be an income statement item. So where do you find changes in equity not associated with the income statement? There literally is, let's call it a sub-financial statement called changes in stockholders' equity. Now, as you might imagine, generally speaking, the first line of this is the net income. But you'll see whatever other changes occurred during the year, you will find in this statement, okay? Now, see, identify all changes there. That takes care of assets and liabilities. When we combine net income and any other changes not associated with net income, we now have accounted for all 5 categories of account.
1230.
Okay, so that being said, if we take these 3 steps and we follow them to the letter, we will have a balanced cash flow statement. And next, I will tell you what to look for. Okay, saying where money comes from and where money was spent, that's a general idea. But I want to give you a few very specific, tangible things that you want to look for. Okay, stop.